The demand curve, price versus quantity. In our previous section, we focused on how John thinks. Now, we're going to look at how those thoughts translate into action within a market. To understand finance and economics at an Ivy League level, you must master the mechanics of the market, and there is no better place to start than the demand curve. When we talk about demand, we are looking at the behavior of buyers. In this lesson, John is our consumer. Whether he is buying software, coffee, or shares of a company, his behavior follows a predictable pattern that economists call the law of demand. According to Gregory Mankiw, the law of demand states that, other things being equal, when the price of a good rises, the quantity demanded of that good falls. Conversely, when the price falls, the quantity demanded rises. It sounds like common sense, but the implications for John's financial life are profound. To visualize this, economists use a demand schedule, a table that shows the relationship between the price of a good and the amount John is willing to buy. When we plot these numbers on a graph, with price on the vertical axis and quantity on the horizontal axis, we get the demand curve. Because of the law of demand, this curve always slopes downward. Let's look at a concrete example. Suppose John loves downloading high-quality digital assets for his GitHub projects. If each asset costs $10, John might only buy 2 per month. He carefully selects only what he absolutely needs. If the price drops to $5, the opportunity cost of buying an asset decreases. Now, John might buy 6 assets. If the price drops further to $1, John might buy 20. The lower the price, the higher the quantity demanded. This downward slope reflects John's rational decision-making. As the price of a good falls, it becomes cheaper relative to other goods, and John's purchasing power increases. However, John's demand is not fixed in stone. While the price causes a movement along the curve, other factors can cause the entire curve to shift. This is a crucial distinction. A movement along the curve happens only when the price of the product itself changes. A shift in the demand curve happens when something else in John's life changes. The first major factor is income. If John gets a high-paying job as a financial analyst, his demand for most goods will increase. If he wanted 2 digital assets at $10 before, he might now want 10 assets at that same price. In economics, we call a good a normal good if demand for it rises when income rises. If demand falls when income rises, it is called an inferior good. Think of instant noodles. As John gets richer, he buys fewer of them and switches to steak. The second factor shifting John's demand is the price of related goods. These come in 2 forms: substitutes and complements. Substitutes are goods that can be used in place of each other. If the price of a premium coding software rises, John might buy more of a cheaper, similar software instead. Complements are goods that are used together. If the price of high-end computers falls, John might buy more software because he now has the hardware to run it. John's demand for software is tied to the price of the hardware he needs. The third and fourth factors are tastes and expectations. If John suddenly decides that minimalist coding is the new trend and he no longer needs external assets, his demand curve will shift to the left, meaning he wants less at every price. Expectations also play a massive role. If John expects the price of a certain stock or product to rise significantly next month, he may increase his demand today to lock in the current lower price. This forward-looking behavior is a cornerstone of corporate finance and investment strategy. Finally, we must consider the transition from John as an individual to the market as a whole. Market demand is simply the sum of all individual demands for a particular good or service. If we add John's demand curve to the demand curves of thousands of other consumers, we get the market demand curve. This market curve tells us how the total quantity demanded of a good varies as the price of that good varies, while all other factors that affect how much consumers want to buy are held constant. For John, understanding the demand curve is about more than just shopping. It is about understanding how value is perceived by the masses. When John looks at a business to invest in, he isn't just looking at their product. He is looking at their demand curve. Is the demand for their product growing? Is it sensitive to price changes? Are there many substitutes that could shift the curve to the left? By mastering the demand curve, John stops being a victim of market prices and starts becoming a student of market psychology. He begins to see that price is not just a number, but a signal that reflects the aggregate desires and constraints of millions of people. In our next lesson, we will look at the other side of the coin, the supply curve. We will see how producers react to those same price signals and how their costs determine what is available for John to buy. But for now, remember the downward slope. When things get expensive, John buys less. When they get cheaper, he buys more. It is the first rule of the marketplace.